Welcome to the first Unpacking the Markets podcast. My guest today is Bate Nussbaumer, one of the proper OGs of FX trading. He's been a trader for 40 years in some of the biggest global investment banks in the world and now manages a large fund for high net worth individuals, as well as coaching retail and institutional clients on trading. Before we kick off, please like and subscribe to this channel so that we can grow and help traders along their journey. Let's get into it. What have you learned about markets managing risk in those crisis moments?
To be honest, I mean, yes, you're just giving it away. It's been 40 years, so it's been 40 years in the making. No, I think the importance with that, the reason why I actually bring you to that is that I remember my first event has been, well, the very first event was 1985, the Plaza Accord, like the big interventions from the central banks when they felt the dollar is overvalued, and we had like huge moves in the dollar thereafter. But I was very green behind my ears, so I didn't even know. Today I know, obviously, this was the biggest event ever in foreign exchange, if you think about it. And at the time I had no clue about it. So what I mean by that is the next thing was the 1987 stock market crash. We didn't know much about that either. So everything we know today about correlations and how things feed together and so on and so forth, we didn't know at the time. So in the 80s, mid-80s, it was all about interbank markets. It was all about just volume being pushed to the market. As a trader, you just defended yourself all day long, 10 hours a day from other banks trying to run you over. And at some point, each of us has huge customer volume that we push through the markets. So like in these days where we have EFX and all this stuff, it's basically been, you had a large client transaction. So you're calling out in the interbank market, try to sort of get rid of that risk. And so the way we traded was not much about what we knew about the market. It was more about managing liquidity, managing risk all day long. So pushing flows through the market, make sure we make like our P&L would be like on the 10th digit of, or the 8th digit of an average of a day of multi-billion-dollar turnover, right? So we wouldn't think where the market is going. The market was going where the flow was going. So basically very basic. And I remember back in the days, to the annoyance of all us traders, when I was at UBS, the management always said, we could pick anyone from the street to fill your seat, which actually at the time wasn't that wrong because we knew nothing. I mean, literally nothing. I started as a 19 or 20-year-old. I've been assistant from the dollar Swiss trader, dollar Swiss obviously being the biggest pair for UBS, of course, naturally, given it's a Swiss franc. And, God bless him, but that guy was a brilliant trader and he has absolutely no clue about anything else. So I was the one, it was a trade balance, trade figures in the US, which was the only number that mattered there. So we had one number a month that we watched, right? And so when the number came out, he just asked me. So I had to show him if it means dollar up or dollar down, right? Yeah. So I don't want to make everyone like bad from the 80s, but it was different. We were traders. So so trading in FX in the 80s was more, I'm not saying there were not people that knew a bit more, right? Probably. But I think the way what we know today I feel it's a lot more sophisticated than it was back then. Back then, it was just about volume. It was about trading. It's like a market stall. If prices go up, you have to protect, like you follow the market that way rather than with intelligence. It was about flow. It was flow all day long. So then, as you pointed out, right? So then every crisis there was, we learned something. So from the 1987 stock market crash, it was probably the first time we started to, I'm talking us as in the broad trading community. Like I said, some people already knew that stuff before, but maybe a minority. So we learned that there are something that we call correlations. That if the stock market tanks, suddenly dollar yen tanks and cross yen tanks and the dollar Swiss tanks. So these sort of what we now understand the carry currencies that suddenly started to rally. So we had a blow up of the carry, which we kind of, so we learned everything that happened in the market. We learned something more about it. It was not natural before that. Yeah, some people maybe had a clue that maybe if stocks dropped, or the yen could drop, but the sort of magnitude of it, I don't think many people knew. And then we go over to 1992 EMS crisis. So that was the first time I think myself and probably many in the market experienced a true currency crisis where currencies just collapsed. Like sterling being kicked out of the ERM. And I mean, that thing just moved 40%. The same like Italian lira, all the club met. So every crisis did teach you something. Obviously, like it is with every other job as well. Everything, works on your experience, adds to your experience. Oh, this, oh, that, oh, this is important. Oh, we should watch this. So it's almost like a collection of events, as if you would read chapters or a little book about something that you start to digest and then know for the next thing. I remember I came to London, so I left UBS in 1997, just before the merger with Swiss Bank. And I came to London, and the plan was I set up a prop desk at Morgan Stanley. I arrived in August of 97. And that just was when the Asia blow up happened. So the Thai baht devalued. They had fixed exchange rate regimes. So this was the Asian currency crisis. And so Morgan Stanley thought like, oh, there's a guy, he sat through EMS crisis. So he knows all about currency crisis. I had no clue about emerging markets. I've never traded emerging markets up to that point. I had no clue about Asia. I just sat down and they asked me, Asian currency is a bit like prop, right? So you don't make like just markets all day long. It's about strategic, it's about risk management, blah, 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 blah. I go like, yeah, why not? Never wrong to learn something new ahead of the introduction of the euro in 1999. And the only knowledge I had when I sat down was, in a currency crisis, things move a lot further than you think. That's all I knew about it, right? And so it was. It just went absolutely bananas for like 6 months. I mean, I had some of my best time. There's many highlights, but this was one of the best times I had. It was so much fun. Luckily, as well, as a shop like Morgan Stanley, you had a quite decent client base, 1 or 2 or 3 key clients that kind of understood Asia, that knew exactly what's happening in Asia, that this is like the real deal, blah, 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 in terms of levels. A currency crisis can only happen if levels are just wrong. If you have a fixed exchange rate regime, but the economies diverge, this is why EMS blew up sterling in 1992. If you have a more or less fixed exchange rate regime, but the economies move away from each other, the currency is just at the wrong place. So that's why it blew up. And so, if I briefly may come back to 1992, this is all these stupid stories about, bad Soros, or, speculators that led to the blowout. No, that's not true. What led to the blowout is silly policies, which having a fixed exchange rate regime to a currency that does not reflect basic fundamentals. So what Soros did in 1992 is just realize that currency is just wrong. Right, so he sold sterling because he said sterling is 20 or 30% overvalued versus its macro background. So that didn't need to be a rocket scientist. It was just the fact that at some point the concentration of size from maybe the hedge funds was that the central banks no longer could withstand the pressure because of reserves. But sterling at the time deserved to fall, and so did other currencies like the lira or the club med. And so in 1997, it was no different. Some Asian currencies was just on the wrong price. And reality is, if something is at the right price, you can sell whatever amount you want to sell, you can't break it. So you can only break stuff that is mispriced. And so was Asia. And so so obviously I then took what I learned in 1992 to Asia, and just knowing, okay, this thing is just going to go ballistic up to a certain point, right? And so that was the only thing I knew back then about Asian currency. And then you start to learn about the individual countries, And so that's like some discussions we had in the past about things where you start to learn the actual true DNA of a country, of a currency, culture. Everything is important at the end of the day if you truly want to understand what you're actually doing at the end of the day. It may not matter in the very moment that you do it, but as in aftermath, when you sort of look back and every chapter had an episode of what you take away from it. Next thing that happened was 9/11, which you obviously can't prepare. That's a totally unique thing. And I remember I was on a phone call with a friend, and we just we talked about it. Said, oh, there's like a plane went into Tower 1. We go like, we talked about, we thought like it's like a little Cessna or something. So we weren't at that point aware of what we were watching. And then the TVs would start to switch on and you could see the smoke. And then the market at that, in the very early stage, the market was just kind of a bit wobbly, but, no one understood. And then we saw the second plane hit, right? And that's when it dawned on the market, and then it just went, right? And so there is something now on a risk event where you basically just had to close your eyes. I mean, there was just nothing you could do. This market just disappeared. I remember the guy next to me, he was the first graduate that Morgan Stanley had. So Morgan Stanley started very late on these graduate programs. I had a graduate next to me. I gave him the task to watch his few orders, so he had something to look at. So I think he watched some dollar sing orders. Stop losses on the downside of the dollar. And I realized, I already knew it just blew up, right? So I saw how he got a bit nervous there next to me. And he said, Beard, I think we have a problem. I said, what? And I said, well, like these stop losses you gave me to watch. I said, yeah. I said, we're way through them. So I think we have a problem. I said, yeah, I know. And so he goes like, so what do we do? So he expected a very, very mature and educated answer from me. And I said, well, what I say to you now doesn't often happen. But what we do now is we just close our eyes. We just pretend it doesn't happen, right? And he was shocked. But that was an event that, you can't prepare. You don't know what to do. Well, you know what to do. There's obviously a market collapse going on, but there was just nothing you could do. Also, now from a Morgan Stanley point of view, it was clear that Morgan Stanley was one of the biggest tenants in World Trade Center. So a lot of things go through your head. So you have to risk manage the orders. So obviously New York got evacuated because the FX part was Midtown, not in the World Trade Center. But so they were all sent home. So every risk came to London. Then we had all the stories going about London, planes on the way to Canary Wharf and all that rubbish. So we had to call the Asian guys. They were all like in the karaoke bars, right? And no clue, oblivious to anything that was going on. And so until we got them in, right? It was like, I think I was the last in FX in the office in London because I was the only guy that was there by car. So I'm just coming from the southeast. So Canary Wharf was closed, right? At the ramps up. They couldn't go anywhere anyway. So I go like, yeah, you guys go home. I can't go home anyway. So I wait for Asia to come in to take over. And yeah, I had my wife on the one phone, my dad on the other. What do you still do in the office, right? So it's a very surreal moment where you see, but you don't understand, right? Because I think that experience for everyone in the market was just beyond anything. And it was the first time, I think there was one or two dodgy clients that tried to do, ask silly prices in silly pairs that are traditionally obviously moving a lot when it's about, because we already knew something. One was the tragedy in itself, but the other thing was very clear, was terrorism. So there's going to be a war right after, right? So you knew that. So some people started to try to pick off some desks in currencies that also have to do with oil, whether it's Norway or some of these other pass. And it was the first time that management was very happy for us to tell these people just, well, I can't use their language now, but just get lost, right?
Yeah.
And Morgan Stanley was fantastic in the days afterwards, where they just said, listen, everyone who has too much stress because of people involved or family involved, just stay home, right? So it was a very, sorry, a very surreal moment. And so the reason I wanted to bring that story home is most of the time we have an answer. Most of the time, yeah, we do risk management. Oh, when it costs that much, we have to cut, blah, blah, blah. And sometimes there's markets where there's just nothing like that you can do, where you have to sit through something very horrible. But what and that was already maybe some of the experience I gained in the meantime, is there is an aftermath. So once the smoke starts to settle, things usually start to function again. So you just sit through, something you can't risk manage anyway. The other reason why I wanted to also bring that story home is, for a very long time after 9/11, it was almost a benchmark of risk. So when you had risk in the years afterwards, and you thought about, what do I have to consider? Because we all risk manager as well, right? Next to being traders. And you always try, as well now as a portfolio manager, like managing risk for high net worth individuals, you always have to think, okay, all the things that are happening in the world as a sort of order on what could happen if, or what happens if that goes. So 9/11 for many, many years afterwards was almost like, whenever you had risk to manage, you go like, we now know how much something were to move if a 9/11. So we often said, even years way later, we said, it needs a 9/11 type of event to cause, damage to your position or whatever. So that was an event that probably gave us a fair bit of an idea of how much something would move if just nearly the impossible happens. You obviously can only peak that, if we talk these days, would be war of some kind, right? And the missiles really flying, and not just in the Ukraine, but elsewhere. And so that was a very defining moment, I think, in the market generally, in regards to, like I said, the word risk. I think we learned a lot about what, these market functionality, which markets start to blow up, but all at the same time, and so on and so forth. And like I said, everything is just there to learn something. Next event, obviously, 2008, global financial crisis, which, you already by then started to realize, okay, 08 was the tap, the credit run dry. And if you've been in a market by that time for like 20 odd years or more, 30 almost, you kind of realize, okay, that's pretty bad. If the flow of money stops, that's basically it, right? So then you have all the trades you learned in all these crises before, risk of equities down, dollar yen down, cross yen down, and probably 2008, if you look at currencies like Aussie yen or dollar yen, whatever, some of the biggest move, Aussie yen had the biggest move in 2008. Maybe had like a period of a rally of 6 years, and it was all unwound in like two months, right? So if you look on the chart, or if people were to sort of listen to this and then look at the chart, have a look at the monthly 20 or 30-year chart in Aussie yen, and you just see that. But this is what we call the up the stairs, down the elevator. That's basically what I learned with every crisis, starting in 1987, over to 92, 97, 98. There we not only had the Asia crisis, but it was long-term capital, Russian deval, and so on. Then 01, like we said, 9/11, 2008. And then came COVID. COVID was probably the easiest crisis in regards to see it happen. COVID was probably also the easiest one, or the one that you had to wait the least for it to unravel. And I think, as I explained to some people, it was also the one crisis where I felt my knowledge of culture helped me to actually make a lot of money. I remember we had the the early wobble in equities when actually the COVID started to strike in China. And then at some point, I don't know, the market must have felt, oh, it's an Asian problem. Like we had a few of these issues before, SARS and other events like in the 10, 20 years before, which never made it to be in a global pandemic. So the market must have just been complacent and saying, oh, yeah, it's a Chinese problem. And the market, I remember the Dow made a fresh all-time high out of this first dip, right? And I go like, how bloody stupid is this market, right? And then came the lockdown in China, the whole Hubei province, which is the heartland of Chinese economy. 200 million people quarantined. So now, and I say this now, and I hope I offend no one, but reality is Beijing is not very much known to care about its people, really. So when they locked down 200 million people and closed their economy, which is the most important thing ever, you kind of should realize there's a problem, right? And so that's the moment when I just started to go pretty much limit risk, like short risk, because China doesn't do this just for fun, right? And it then took Italy. I remember like it was yesterday when we started to see the pictures in Italy, because Italy was the first one to really get badly hit outside from China, or at least in the Western world, is when the market started to realize, oh, we have a problem. And actually we have a global problem. That's when the market just started to collapse. So markets on the charts is a bit harder to see because the market is so high up that in terms of visuality, it's like when I show a monthly chart back to 1985 in the Dow, and you hardly can see the 1987 stock crash. Yeah, obviously it was like the level was like at 1500 and I'm like at 40K. So if I show the chart, someone goes, what are you talking about 1987? It's like nothing, right? But you forget that this little bit was about 50%, right? Of course, you can't see it now when we're at 40K, right? So when you look at it, but the equity market was actually tanking quite a bit. And this is something we sometimes spoke together already before. This is where the market is so different to, or the market today is so different from the market in the past that I got to know, which is a market that is based on a lot of electronics, algorithm, quants, blah, 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 blah. Not that many human traders anymore, because the market used to be very good in pricing in risk. They saw something happening, go like, oh, I don't like it. Okay, it doesn't mean like you have to go, as a trader, you may go short, but as an investor, you maybe just cut risk. So you go from, I don't know, limit long equities to maybe 80% long equities. I mean, we know these portfolios are not just getting cleaned out, so they just get managed. But there's nothing. It's like new highs, everything is good, who cares? And then we had this huge drop. And these huge drops only happen because the market is stupid these days, or complacent, not actually pricing in this risk. We could have gone from the first wobble, bit of recovery, we could have gone just grinding down for a few weeks. So we probably would have dropped 10, 15% in like 2 weeks, 3 weeks, just sort of pricing in the risk. And then maybe the rest risk, when it really started to happen, the move would have been a lot smaller. Now what happens is, right? Total stupid. But to be honest, it is what it is. This is what you learn when you're in the market for a long time, is you have to also be, and this is maybe my advantage of being in the market for such a long time, but still trading means I also understand the changes in the market, because the market changes, behavior changes. The core DNA doesn't change, but how things operate changes. So back to your original question. So every one of these events, you learned something about it, right? Which made you a better trader, which made you aware of, oh, this is, I remember before, I think after the Asia blow up, the next few years later was Brazil, the devaluation in Brazil. And I remember talking to our New York guy and said, hey guys, I have no clue about Latin America, but I just can tell you, this feels like it felt back when I was sitting through the Asia crisis, right? And a lot of people in the US were oblivious to, they were just carry traders like long Brazil, blah, 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 blah. Then it just blew up, right? So you can, there's almost like a handwrite. There's a DNA that you just sense when you run through such events. You start to smell it. You develop a pattern. It's a mixture of pattern recognition. It's a mixture of just gut. You just see how something moves and it doesn't make any sense, and then you add on the news what should happen and what doesn't happen. So you just see a lot of things adding up that make no sense, and then it just happens, right? So yeah, my advantage was I don't have to read books about all this. I sat through it, so which is obviously different when you experience it firsthand. And as you know, this is the stuff where people, when they do the sort of trading courses with me, stuff that I try to bring across in first-hand experience of what this is about, and what is to learn, and what correlations you have to learn, what DNA you have to learn, what kind of culture you have to learn. So it's just all the important part, because it's not all about just economics or numbers. It's a lot deeper than that, right?
Which is a great segue into what I wanted to follow up with, which is, I guess, because when you were talking there, you can see how many moving parts there are in the market, right? It's like there's just so much going on. So for a newer trader or a newer person trying to come and understand the markets that may not have or want to wait 40 years to go through every crisis, right? How can someone start to, I guess, to learn about what the market is and what it isn't? Because you touched on economics there, and maybe I think I remember, maybe not you, but someone else saying when they had graduates on the trading floor, they used to say, forget everything you know about economics. This is different. What I'm going to tell you.
I told you that actually as well.
Yeah,
maybe someone else as well.
I knew that, but I wasn't sure if you wanted to disclose that.
Sorry,
I gave you the chance to stay out of it, right? But yeah.
Brilliant.
But you see, my question is like, how can they start to really grasp and just understand what's going on?
To be honest, this is a multi-layered question, and the answer is also going to be multi-layered, because it's going to be addressed to different segments of people, right? If you talk about a retail trader, which, as you know, 70% of people that look for my help are usually advanced retail traders, people that tried it, didn't work, and realize, it's actually a bit harder than they expected, which is normal, right? So they seek help. Then there's the other part, which would be on a professional level, right? So there's two different, graduates that come into the market now, less maybe gray hairs at the desk that could sort of teach them that. So when we address the retail world first, so everyone who, a lot of people are fascinated by trading. Yeah, of course, right? Because people feel, my job is okay, but I wouldn't mind making a few bops on the side. How hard can it be, right? Which is usually the core sentence. So those people, I would say, and I'm always honest to people, because my first job is trading. I don't have to sell courses. I'm in a luxury position of that. So I tell people exactly what they get and what they don't get. What they don't get is there is no get-rich-quick scheme out there. Only hard work. That's the first lesson. So all the stuff you see with the yachts and the Ferraris on the front page, just move over. Those are scams. Those people just after your money. Reality is, I'm not against self-study. But the problem is, if someone does self-study, well, who tells you that you know what to study, right? So the problem is, you may already lose a lot of time by reading the wrong thing, right? If someone is really serious about learning this, you need to have a tutor, period. This is the same when you want to really play the piano. You're not going to do that with self-study. Yeah, maybe 1 out of 1 million is just so talented that he doesn't need help. If you want to be a sports person, I'm a big tennis fan. If you want to play at a certain level of tennis, you need a tennis coach. Sorry, it just doesn't work other than that. Well, we're not talking the total pros, which now have nutritionists and this and that. I mean, they travel with teams of 10 people or whatever. So that's a different level. But what I mean is what do you need as a retail trader when you come into this world? You need someone who just, in a nutshell, can tell you where to focus, right? So what I teach is basically I condense 40 years into, we start off with things like what actually moves these markets day to day to day to day, right? Every single day, right? And this is not even, macro comes in at a later stage, but not every day is about macro, as you know yourself. So there's so everything out of these 40 years, correlations, carry, like there's so much which actually we know, okay, if this happens, that happens, if that happens, that happens. So we have a lot of tricks up our sleeves, but it's not just tricks, it's actually, that's how the market moves. That's why the market moves and how the market moves. So that's the one thing. When we talk institutionally, that it gets a little bit complicated, because some people are lucky enough to have still people in their organization that are willing to talk about it, to teach people, and second, to actually know, to have been there, right? So the problem these days, which I find a bit a shame, and I noticed that even in the city of London, where the talent pool just dropped with the exit of many of these people, you now left with a EFX and an algo that teaches you absolutely nothing. The only thing the algo system or EFX, and I may now start to make some people angry, but EFX traders are not traders, sorry. They don't understand risk to the same event as people understand risk that actually carried risk through the normal old days. So it's a different world when you're just suddenly more concerned if a client made you lose a pip or two on a transaction. So it's a lot of statistics going on and trying to make the system efficient. Yeah, that's why at some point this is all going to fall apart, because it's all the same price. People stream all the same price. But actually we go away from, that's another round for another day. What I'm trying to say is, you're running out of people out there that actually can teach people, because one thing stays the same. This market has not changed. And I said to you a few times before, and I say this every time I can. Macro has not changed. Macro will move the price from A to B. What has changed is how, right? And the how is where and that's why I said earlier, I had to evolve over time. I always have to look at my strategies, and when I see the hit ratio drops, usually it has very little to do with what I do, because I operate on a certain regime. So if suddenly hit ratios drop, something has changed in the market. And the last 4 or 5 years, that was definitely the case, where I could tell how we morphed from, even less humans to more machines. So that the human element in trading in FX, I'm just talking FX now because that's where I am the expert, or so I think, is the big difference. And so you have to adjust your trading styles. If you see something should go down and you sell it and it goes up, then you're just wrong up to the point it goes down, right? And so with the complacency and with the delay, where sometimes certain stories have, where a discretionary trader may already see a few elements why a price should start to peak or turn down, and it doesn't, then you just have to approach it different. Smaller size, more clips, you have to leave more room on the upside so you don't get stopped at the highs, and so on and so forth. But that's more a tactical story rather than... but my message to anyone that is trying to trade, like I said, retail, look for a good tutor. Institutional, make sure you find someone that is willing to help you, either internal or if it has to be external, right? Because reality is, when you learn this from the ground up, you have a lot easier life, because there's a lot of, I would say, I want to be careful with the word easy. It's never easy. But some of the stuff I know makes certain things at times easier. There's still a lot of
Yeah.
hard stuff out there, right? But if you can mix it with a few things that you know due to the DNA of something, or you know, okay, if that happens, this happens. So you have a few free trade is again a dangerous word, but there are a few trades that are easier or nearly free, or let's put it this way. If we talk actually the real game, which is probabilities, there's a few things that you know from things we know, where a certain trade may have suddenly a 70-80% probability to work, versus the usual market, which is 50-50, if you want to argue, right? Well, with all that we do and study, we hope to skew it better than 50-50, but there's things that are at 80 or 90% probability. And so as a trader, you need those things because you also lose. I lose money like everyone else. So if a trader tells you he doesn't lose any money or never lose any money, he's just lying. That's not true, because it's actually just not possible. It's the risk management that keeps you going, right? So when you lose, you don't lose too much, and when you make, you try to maximize that. But that's again another story. Risk management.
We'll get to risk management. But one point I definitely echo there is that when you said, a tutor will keep you in line, like you're kind of playing, trying to land. It's like you can go off track so easily as a retail trader. And one of the benefits, I think, I guess actually the biggest benefit I've got from having, say, you as a tutor is, as soon as normally on my own I'd go off track, I just send in a message to Slack, and then you bite my head off, because it's like, why the fuck you telling me? But no, as in you keep me on the correct line, right? Because 1 inch out of line, and actually you could end up somewhere at the end that's nowhere near being profitable as a trader.
Correct. To be honest, I think what people underestimate is how disciplined we are, what strong regime we build around us. Because trading always comes around, and this is, I think, why people are fascinated about trading. Two things, right? One, they feel like it's a lifestyle, which, yes, it is, right, if you're successful. But they see the other side of the lifestyle, the champagne corks and the fast cars and whatever, like the shortcuts to a luxury life. And the other side, traders come across, oh yeah, these cool guys, they're like, whatever, easy peasy. No, it's not. We actually a lot more regimented and disciplined. Yeah, during the day, let's say, I'm not saying, traders are a different breed maybe, but underneath is a very disciplined, strict regime, from risk management to trade planning to we do not leave a stone unturned if we can turn it. Which means what I said earlier, hard work, right? Would I still need to work 12 hours a day or more? No, okay, I'm a bit nuts because I just love it. But it's what I always say to people, what you put in is what you get out. If you leave nothing to chance, so you sit here anyway. So people don't treat it as a job. So if someone thinks about trading and he thinks about leaving his own career in favor of trading as a full-time job, what people underestimate is it's a job. It's a job, and the job starts at some point in the morning, it ends sometime in the afternoon. Yeah, okay, or evening. Yeah, the only thing I remember, I had one guy once, and what people always underestimate when I have a call with them, they always think they just look at who I am. No, I look as well at who they are. Right? So I want to understand, because I love teaching, but only people that want to be teach and want to learn and understand that this is not coming easy. It's actually hard work. And because if people think it's like a quick story, then they're always going to be disappointed, because you have to put, that for yourself, how much you have to put in as well. Yeah, you get told a lot, but you have to make it work, not me. I can't be in your head to do it for you, right? And so everyone has to be ready to learn, but then put it into work and keep it up, right? And that needs quite a bit of metal. Also, patience. I always talk about a journey when people start, and they may not quite understand what that means. Over time, they start to understand that, okay, you start to learn, yeah, it doesn't make you a rock star trader yet, right? So the whole thing needs time. You get better every month. In 6 months, you're a different trader to today, in a year or 2 years. So I would say, anyway, it's like going to the gym, right? Those people who go like, oh yeah, New Year's resolution, go to the gym, get a bit fitter, lose a bit of weight, then they go. First 2 months is fantastic because if someone didn't do a lot before, he starts doing something, you shed a few pounds very quickly. And then comes the period where you don't shed a pound at all for many, many months, right? And most people give up, as we know. That's why gyms love year end, because they can sell so many membership for people that actually only turn up for 3 months. The other 9 months, then nowhere to be seen.
Just guilty
Right?
at home. Yeah.
That's the same phenomenon as in trading, right?
Mhm.
People go, they learn, oh yeah, cool, blah blah blah, and then they go like, and now, right? I'm not a rock star yet. Yeah, of course you know, right? I wasn't born a trader. The only difference, and this is why I think retail needs help, is I had the luxury to learn everything I know through the banks trading, right? Not with my own money, right? So now trading your own money is a complete different ballgame, right? So you want to actually learn from someone. You still make mistakes, but because you also learn risk management, those mistakes shouldn't be that costly.
Mm.
But the problem that 80 or 90% of retail fails, you burn your account in a week if need be, right? Very easy, right? Wrong risk, wrong size, wrong whatever, everything wrong, right? And so it takes time, and like I said, it's a job. If someone considers trading, take a tutor. That really cuts out the pain in the beginning. I have people that came to me after they lost 50 grand, 100 grand, 200 grand, and I can tell you what, none of them would have lost that much money if they come here in the first place. Yeah, I'm not cheap, but I'm not that expensive. I mean, if you look at the cost, it's a fraction of the money people were to save, and they're losing like silly amount of money, and you have no chance, right? You have no
Yeah.
chance. I had just maybe one anecdote quickly. I had a guy once that sort of interviewed me or asked me about the course and this and that, and he was a pilot. And so he asked, oh, if I sign up with you, what do I get? What do this and that, blah, 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 blah. And that the sort of whys and so on and so forth. And I told him all about it. And then I asked him, can I ask you a question? I said, yeah, of course. I said, listen, and this is now actually true. I wanted to become a pilot when I was a youngster, right? From astronaut to pilot and so on and so forth. And as you do as a youngster, you read a lot about it. You've done the flight simulators. I actually have done some real flight simulators as well, subject to some of my presence in the past life, when I was younger. And so I said to him, listen, I read many books about flying. I'm flying like I'm regular flying a flight simulator. I know a lot of pilots that I chat to, right? So would you let me fly your plane tomorrow? so, so he sat there for a moment, and then it dawned on him, and then he started laughing, right? I said, yeah, that's it, right? That's it, right? I'm not calling the guy in the hospital, say the neurosurgeon, and tell him, listen, yeah, stay at home. I think I'd take that one. Right? No, right? So I have no idea why in trading, no matter if it's FX, equity, whatever, people that their background is not trading, I have no idea why they think they can just come here, roll the dice a few times and be successful. How? Right? And this really, no, I don't understand it, right? Because common sense already should actually tell you that every job has a learning curve. Every job, even the job these people are in, usually have a learning curve as well, right?
Yeah.
I'm not an IT guy. If I have an IT guy, I can't, to be honest, embarrassing, I can't even do a spreadsheet. But that's a different story. That's just my age, and I always had someone that done it for me. But it's no excuse. I should have learned it one day. But just saying, it's. I'm not sure where the complacency is coming from. But one thing I can for sure say: people that think they can do it on your own, forget it. You can't. You just can't. can self-study bring you a certain way? You work with certain strategies, and if you're lucky, you make a bit of a little bit of money here or there. Not impossible, right? But you can never grow it to be your job. And if now some people call me up after watching the video and say, I can, okay, we're talking there is always 1 or 2 out of a million who could touch anything. That's just how it is, right? So I'm not saying there is not someone that could have done it or does it, but the statistics are clear, right?
Yeah. And in that, you mentioned, and to divert a little bit towards macro, right? And in FX markets, you said macro is still and will always be what moves price from X to Y. But you don't just talk about macro, right? You talk about something called tradable macro.
Yeah.
So what is tradable macro?
Yeah. How much time do you have? No, it's so. Yeah, I usually try to explain it to people. I say tradable macro. I gave it another name, which I just call it narrative, really, usually. So everything, like everything has sort of a broader idea where it's about going to go, right? This is what banks try with their forecasts. Oh, we expect that many cuts. We expect the dollar to go there, blah, 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 blah. But literally every bank, and this is no disrespect, that's just how the game works. Every bank has to come out every 3 months to adjust their levels because, quite honestly, either they can't be reached or they were wrong and we've gone the other way. So it's very hard. You can have the broad view. Yeah, we have the broad ideas about what the Fed is going to do, the ECB, and that's probably the underlayer of what I call it. You may have create a bias of being bullish or bearish something by the outlook for the year. But then comes this week for week or multiple week for week or month for month for months, where nothing works in a straight line, right? So we have suddenly a bunch of actually quite right now it's actually quite fascinating because the central banks don't really know more than we do because they tell us we're data dependent. So what does that mean? The data is zigzag, right? So you can be bullish as much as you want. If you get a set of weaker data for a few weeks, the market is going to go down, right? You can be bullish as much as you want if the data is speaking a different language. So tradable macro really means we're going from data point to data point to data point. If we're lucky enough and the data point develops in a non-flip-floppy way, so creating a general trend, yeah, then our core view is okay, right? So our macro view and the more shorter-term views match. But what you have is suddenly like right now, inflation is obviously one of the hot topics all the time. How many cuts do you get? We flip flop from 3 to 2 to 1 to none to 1 to 2. Maybe people could look at the euro, for example, in 2023. The euro was more or less in the 105, 110 range. Why? Because the story is about the same in the US as is in Europe. Some weaker data, some stronger data, more cuts, less cuts. Every week with the data set is like, oh no, it's not 2 cuts, it's 1.5 cuts. We flip-flop. So that means what? If you just buy your euro at 105 and wait all the year, you're getting nowhere. So we're trying to trade these, in FX, 2-3 big figures, 2-3% is kind of what you get in these kind of weeks or multi-weeks period. So as a trader, and there we have to make the very big distinction between being a trader or being an investor. If you trade, you're not an investor. You're not picking the next big trade and hope that it's going to be right. And there we also have to distinguish between FX and maybe equities. Yeah, you can be a Warren Buffett and you can buy equities, and if you don't have to touch your money for the next 50 years and you're lucky, the markets be higher in 50 years from now, right? How much money that creates for you, who knows? Because end of the day, investor is easier to be when you have a lot of money. Most people don't have a big amount of money that makes investing lucrative, so to speak. Well, depends what outlook you have. But when people start trading, we trade. We're not waiting for the home runs. The home runs, actually, if we talk about them, we just named them before in our intro: 1985, 1987, 2001, 2008, 2020. Those are the home runs where something just goes and doesn't stop. The rest is trading. So now if you think about it, if you have to, so the big events happen on average every 10 years. It's a lot of time you waste to try to have a home run. So we trade. So when we see, okay, we bearish dollar, let's say, and we have a few weaker data set, okay, so we trade the dollar for the dollar downside for like a week, for 2 weeks, for a month, for 2 months. We don't know at that point how long that's going to last. And as the data shifts, we readjust. So what tradable macro means, or trading the narrative as I call it, is we're very close to the pulse. We're very close to the changes, right? So we trade, like I said, we had a stickier data a month ago on the inflation side in the US, so the dollar rallied, blah, 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 blah. And now suddenly we got softer data, more benign CPI, more benign PCE. Some of the data started to kind of disappoint a little bit. Yeah, suddenly we have like, so that dollar up started to shift to dollar down, and the dollar down will stay until we were to suddenly get, we have ISM today, we have, manufacturer ISM today, service ISM on Wednesday, we have payrolls on Friday, so we have a big data week, for example, this week. So the dollar is approaching these events more a bit on the softer side. Yeah, if the data all comes stronger, okay, maybe the multi-week dollar down is over and we go into a multi-week dollar up until the data gets soft again. So tradable macro means we're very close to the pulse. We understand these very small shifts where something is suddenly priced, and that stuff needs a lot of experience. That's what people learn, is to start to understand, okay, let's say you know yourself, you watch the markets, 108.90, 109 just seems to be the level right now. And for the euro to break there, we need fresh, weak data. Otherwise, we're just going to stay in the range. We have ECB on Thursday as well, which we know are going to cut rates. That we already know, that's already priced. And now we want to see what do they say. Like forward guidance, how many more cuts can we expect? Right now is a second cut is probably priced more in autumn. So it's these changes that we after. That's why, like when you man chat rooms, you see our focus on these events to try to read out where is the. So I explained you always the needle, right? Down, up, right? So we trying to be, with all the work we do on the macro side, we're not just saying, oh yeah, we think this is going there in like 18 months. Who cares, right? Because in 18 months we might not be there. And if you depend on income, making money in trading to have an income, you definitely can't wait 18 months to see if you were right or wrong. Because if you were wrong, you have a problem, right? You haven't made any money for 1 year or a year and a half. So what we do in the tradable macro, yes, we may have a bias, a broader bias, and with the short-term adjustments on data. So everything is from data. Everything I do is from data at the end of the day. But I understand chart levels very well. I understand, I call it risk-reward levels very well. And I understand, and this obviously comes with experience, I understand what kind of move I would expect from certain things that now happen in last week, for example, and the new levels we reach. And I understand what is needed from here on. And that's the key. What is we need from here on to shift that needle? Because one last thing I want to say to this is, and this is also going into a little bit into tradable macro, is I'm a big believer in the efficiency of the market. That means every price you see is the perfect price, right? Because everything we know up to this point should be in the price, because the market had time to adjust. Whether we agree with that price level, which in the yen I would disagree with that, but that's a heck of another topic. But generally, from a day-to-day, week-to-week perspective, everything should be in the price. So where should our focus be on our work? Our focus should be on how we expect the data to change. The next data, or the next key data, not like tier 2, tier 3 data, the next prime data. Why? Because the market will then adjust to the new to the change, right? So we can only make money with the next move. So that means we have to gather intelligence or get a good feel of what we think that next move is going to be, because that's where the price is going to adjust. So we get the stronger numbers of the dollar rallies up to the point where that sort of event is priced, depending on how much better the data was, or in case of weaker data, how much weaker data was, and the dollar falls. So we do these adjustment moves, and that's tradable macro. That's the narrative. So we, in these changes, at the end of the year, you can look back and say, yeah, everything trended at the end one way, but even inside that, you can make money as a trader. Or you see, like we saw in hindsight in 2023, where the euro has gone nowhere, the dollar has gone nowhere. It's just kind of flip-flopped, right? And so as a full-time trader, you also have to make money when the market is going nowhere, and you do that by what I call tradable macro.
Yeah, and
that is tradable macro for me.
Yeah, and the topic of, say, building that narrative, to kind of sum up, is you watch per country what the major macro data coming out, and then you watch the pulse on the news, and then per country, what's the story in that country, and that gives you your view on a currency pair. Right?
Correct. And on top of that, you probably would also obviously know, the sort of positioning, because when you're in the market every day, you kind of know what the market did. Sometimes we have data like from the IMM, CFTC data, but if a market rallies over a week or two, the market is long, right? So you don't need to be a rocket scientist. So if a market rallies for 2 weeks and you get the bad news, guess what? The market's going to fall, because the market is most likely going to be long, right? So we don't have to think something. So sometimes it's also about pure instincts and knowing what's going on. It's like every job. Yeah, you learn the macro, you know what's coming out, you know what the data is, you know what means bad data or weaker data. But as a market person, you also know the positioning of the market. What is the market talking about? And this maybe I want to out inject as well, in regards to when I said earlier, what sometimes a smart way of looking at things is. There are certain things I totally disagree what the market is doing, but I have to know what the market is thinking, right? I may disagree, but I need to know what they think. People sometimes ask me, what do you read? Do you read research? Well, I do a lot of my own research, but of course I also read stuff. What do I mean with that? Everyone should have maybe 1 or 2 or 3 people they like to follow, they like to read their stuff to read, which doesn't mean, oh, this guy thinks this, so I do it as well. That's not the idea. The idea is just, I read 1 or 2 other things, I read them, I store them, and I don't consider them at all for now. I have my story, he disagrees, okay, I put it in the back of my mind, I trade my stuff until it doesn't work, right? So let's say I have view A and he has view B. I trade my stuff and I just realize, it's kind of not going, right? So when I realize that my story seems to have a few issues, I bring back his story, right? And I read it a second time. I go, okay, he has a point there. So this is really about, I'm totally against copying people. I hate it. That's why I try to educate people to a level where at some point in time, not in the beginning, but eventually, they can make their own call. Because we're all different, because as you know yourself, trading is also a big portion of it is psychology. And we're all different. We all take in news different, we digest it different, we have all different levels of experience, be it market or as a human, right? I remember a few years ago, a friend of mine asked me to teach his son. And so, yeah, why not? And then I thought, like, how hard can it be? The chap was, I think, 18 or 19. And when I realized I got myself into a really big challenge, because that person had no experience about anything in life, meaning doesn't watch news, right? So I just haven't got a real clue about the world other than the place he may go on holiday, right? So I mean that not in a bad way, but the difference,
Yeah.
right? And that's where the difference is. So this job is a lot about so many other things too, on different levels. What you can chip in. I sometimes get asked, oh, who are your best students, or those who grasp it very quickly? I said, well, there's two layers. One is all those who work hard, but the other ones, when I had to pick a job, it would be the pilots. Why? Because they bring something to the job as traders that they are familiar with from their own job. They're risk managers as well, right? They go through a bloody handbook before they start the engine, right? They have, when we talk correlations, when we watch the whole market. So as an FX trader, I'm watching equities, I'm watching bonds, I'm watching credit, I'm watching commodities. I mean, there's nothing I don't watch, right? Well, they're used to that. They have a cockpit full of bloody lamps, right? And they know, oh, if that one goes yellow, it's not so good, right? And if that one goes red, it's pretty bad, right? So they used to kind of observe, right? So they're very good observants. They usually very sharp, right? And they understand risk reward, right? So they bring some jobs bring something to the table as a trader, because underlying they have similar things they have to, or it's on a similar level on some degree, right? Which has to do with emotions, with character, like all the things that is not about topics in trading, all the other things, because you need to bring two different talents, so to speak, to this job, right? Not just you can learn everything there is to learn, and if you have a problem on the psychology side, you're a horrible trader.
Yeah.
Right. If you don't understand that side of it.
Yeah, and you touched on a little bit there when you mentioned what the market is thinking and listening to the market, watching all asset classes. Can you expand a little bit on how you do that and how it impacts your FX trading? Because that was something that was new for me. I know you say the pilot is a good analogy for someone that does that, but maybe it's just FX traders that seem to always watch everything. And obviously it's because of correlation, but I know it's a big thing in your own trading.
Yeah. To be honest, you got to be, I mean, first of all, it's about when you trade FX macro, right? So maybe there are people out there, day traders, swing traders, whatever, that they just watch the market that trade. They don't watch anything else. Here we talk about the macro trader who tries to make his living based on various factors, considering macro, considering charts. I try to marry the two, as you know, to define entry and exit levels, so to help my view how to plan a trade. And then the other side is really where you got to understand, and it's actually other asset classes influence foreign exchange markets, because every market, so the whole thing is connected to each other. There's no standalone market. Yeah, there's some that matter less and some that matter more. So I'm not saying every market matters to the T, but they matter at some point in their cycle. Maybe a little example, 2008 global financial crisis. It's obviously a credit crisis. I have no clue about credit. Zero, zip. So from 1984 to 2007, I needed to know nothing about credit because it didn't matter. So I also just admit another thing, which is we FX macro guys, we're a bit lazy on some level. We only just learn what we need because there's so much we watch. We can't, stuff that doesn't matter too much for a long period of time, we drop, right? So in February 2007, I drove to work and I heard 2 credit funds from Bear Stearns collapsed, right? So that was the early stage of the crisis, actually. And I knew, I have no clue about credit, but I was at Goldman Prop at the time. So we were 10 guys, 2 guys per asset class, so to speak. We could trade everything, but there were 2 experts of each asset class. So I go, okay, there's a credit guy in the office. I'll ask him, all right? So I ask him, come in and ask him, hey, what about these 2 credit funds on Bear Stearns? So the first thing he said, oh, don't worry. One thing I learned already in my career is if someone tells you don't worry, it's time to worry. Right? And then the second thing it said, there will be no contagion. That was my second alarm bell. But anyway, so I learned about CDS, credit default swaps. And I started to realize, oh, that's like in our usual correlation world is equity down, risk down, right? And suddenly you go, oh yeah, CDS is the same. If CDS blows up, that's also risk off. And probably the equity guy watches the CDS, but the CDS you only watch when there's stress, right? There can be years and years and years of no stress. So a lot of stuff we watch and know, we know when to bring in and when to just release, right? If it's no story, I have no time to watch something that is no story. If something like when we had this little episode of the Silicon Valley Bank collapse, right? Oh yeah, I watched CDS, US CDS, bank CDS, regional bank, whatever you need, you watch, right? For whatever period it takes, right? So I was watching the US regional bank equity index for about 4 weeks, right? And every time that went down, I've sold a bit of dollar yen or euro yen or Aussie yen, risk off, right? Because the broad equity market would drop on this, right? So you just have to, this is like, I'm not sure if how well, especially the younger listener, the expression they know about the canary in the coal mine, right? So briefly, for those that may not know, is in the olden days when people went to underground digging coal or whatever, in order to protect their life, because there wasn't obviously a lot of, clever instruments back then, they took a canary down into the mine, because a canary dies a lot earlier than a human would die if the air turns if the air has too much carbon monoxide. So basically, and then they all run out of the mine. So this is, and I use that sentence a lot these days, and I think a lot of market professionals still do as well. So we have things that we place in the market that are our canaries, right? So whenever like something starts to, well, some stuff we watch all the time, as you know, equities and bonds and whatever. And then there's some stuff that doesn't matter for maybe a few years until it matters. I usually say it doesn't matter until it does. And so credit is one of them. So suddenly the equity correlation with FX is replaced by CDS. So if credit spreads move out, it's a negative event. So a negative event means equity is going to drop, risk FX is going to drop. So we have a lot of these canaries out there, and this is why you have to learn a lot in this job. And if you learn these things, they actually help you to actually know what's happening next. I usually explain it to people in a way that you have, I call it blanks. If someone starts in this job and is not educated, you have just a whole lot of blanks. You watch this market, you have no clue why it's moving, right? Maybe occasionally you understand the move, right? So you have blank, 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 understand, blank, blank, right? Now the problem is the amount of blanks means you can never build confidence. You're always out of your comfort zone. You watch something, you have no clue what's happening, right? So when you educate yourself through a tutor and then yourself, is you fill in those blanks. You may not trade every event in the beginning that you learn, but you start to understand. So suddenly you sit here and you go like, oh yeah, that's moving because of that. Oh, I see, we talked about this is because of that. And suddenly it's like, clear, blank, clear, blank. And suddenly the whole dynamic shifts. So if you go from understanding a majority of what's happening in the market, there's always something you don't. Oh, I don't either. Sometimes they are just random moves. But you then suddenly build confidence. You go like, okay. And with confidence, I don't want to mean, oh, it's easy. No, or being complacent. But it's kind of, it creates a bit of something. I'm like, you know what? I kind of learn. I kind of start to understand certain things that happen. When you start to understand certain things that happen, you start to make money because you get a lot of confidence about stuff. And the second thing is you actually truly start to understand what's moving, right? And so I watch everything that I can that at some point would give me that advantage. So knowing stuff in other asset classes gives me advantage over everyone that is trading FX. And I know more than many people do on what matters for FX, because a lot of people these days don't learn these things anymore, right? So I know things from other markets. So I just go, okay, boom, 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 boom. And why would you not learn it if it gives you a heads up over other people in the market? So it's work. It's not like insight. It's actually just know, okay, I watch CDS and I watch this and I watch that. I watch that bond, blah blah blah, and that's it, right?
Yeah.
So it's the more you learn about what can influence the price in FX as an FX trader, why wouldn't you? Because you get that free trade that I call about,
Yeah.
right?
Yeah. And I want to shift a little bit towards trading, because it's trading specifically, because it has come up in and out of understanding the market and macro we've talked about, and more specifically risk management. So I heard you say with Stephen Goldstein that the number one thing that kept you going in 40 years was, or if you had to attribute one thing, it was risk management. So when you take on new, say, retail traders, what's the first thing you tell them, or one of the most important things you tell them about risk management?
To be honest, those is a bit. So usually the first lesson is risk management, which is
no.
not the most exciting one. No, the problem is risk management has various layers. But the first one with a new trader, I would always just have the very rigid risk management of a notional number, what you can afford to lose on the day. That is in context of, and there's a formula we use, there's a context of, this is your account, this is how much you are prepared to lose in order to, because if someone opens a 20K account, he doesn't necessarily start with the idea, I want to lose 20K. Right? Maybe they will only lose part of that 20K, or so to call, invest in an attempt to try to manage trading. So there's the formula we use that breaks it down to a weekly or a daily or weekly stop loss, whatever people fancy. And so that protects the account. From there on, when we go into the real trading, there's like all these other layers. So there's like 5, 7, 8 different layers of risk management, but you can only introduce them once they understand trading, because there's a lot of smart layers of trading to know when to put the foot down, when to put the foot off, to understand. Sometimes I have trades where I just know what's going to happen because of the correlation, that I understand this. This is now one of these 80 or 90% probability trades. Yeah, you would be stupid not to have more risk. While a trade that is less clear, you have less risk. So it's a lot of, but at the start, for most retail, it's about to secure the account. That's the paramount job that I have in our first lesson of risk management, is to make them understand what actually risk is. What is risk? And what is the right size of position? And the right size of position is so that you can stick to a daily stop loss. That's the right size, right? Because most retail traders, not only do they don't know about risk management, they're always too big, right? So there's a wrong connection between the size of what they trade versus the underlying size of their account. That's why they burn the account very quickly. And that brings me to that problem that is the problem in retail, which is retail accounts are therefore always underfunded, and that's a problem. So if you have a 10K account and you lose 7, you add 3, that's it, right? Because you don't get back to, you lost too much, right? So in order to just get back to 10K, you would start to take a lot more risk. You need to be much better. I'm not saying it's impossible, but the problem is you have to make sure that you don't lose 70% of your account in the first place, right?
Yeah.
Because there's no comeback.
Most people do, right?
Yeah, there's no comeback, right? And so job one is just, because most that seek me out are already trading usually, so that we just make sure that the bleeding stops. So we stop the bleeding with a crash course on just hard numbers. Boom, boom, boom. And then through the course, when I actually add the knowledge, then I introduce them to these more smarter ways of risk management. But you can only introduce them when you actually start to understand other things, right, in the market.
Yeah.
And understand risk as well.
Yeah, because you have quite an interesting approach in marrying psychology a bit with risk management. So I know you said there was a number of layers. I think one of those layers for retail traders, or one I found quite helpful, is trade planning. So
Yeah.
can you talk a little bit about why you trade plan and how it impacts your psychology a little bit?
Yeah, to be honest, it's actually, we can sort of sum it up very quickly because the actual session about it goes a lot longer. But the reality is you can only be uncomfortable with something you don't know. That's basically in a nutshell. So when you trade plan, you know what you're doing, you know the costs before you actually doing, right? So before you have the risk, you know the cost. If the cost is too big, okay, you have to cut your size. Very simple, to the level that you're comfortable with. And so that makes you also a better trader, because most people, and this is now going deep psychology, I would need to really do the proper presentation there, but you go into a sphere of your brain, which is the stem brain, which is the brain of the Neanderthal, if you want, or the primitive life forms, the flee or fight ones, right? And that's where an uncontrolled trader brain keeps on ending up. You're not ending up in the big brain where you think about stuff. No, it's emotional. So when a trader has no trade plan and his trade starts to fall apart, he's like in the most primitive form of the brain, which is a high level of fear, and you will stop out probably at the low or at the high. If you're short, you stop out at the high, and if you're long, you stop out at the low. Why? That's just how it's going to be, because the pressure is so big, it's so stressful to see your money disappear that you will end up making the wrong decisions. And that is why retail loses, because they don't know. I can visualize to people what that part of the brain is and how we skew it. I skew it obviously to the other side, but that would be probably a bit too long here. But in a nutshell is, if you know what you're up against, if you plan your trade, that's it. There should be no stress. And I always say to people, the day trading gives me stress, I quit, because I don't have stress. Yeah, I have crappy days like everyone else at times, but that's just life as a trader. Welcome as a trader, right? The roller coaster to be a trader. And there's probably only a few jobs where every day this market tells you if you've done a good job or a bad job, right? Yeah. It's not everyone's person's not everyone wants to be judged every day, right? Yeah. So it's not that easy, right? And this is, I think, another learning curve for retail. When I ask them, when we do this first lesson about risk management, I go like, how much money are you prepared to lose? Well, they look at me and go like, oh, fuck, that's not why I'm here, right? I'm here to learn to make money. Yeah,
to make a fortune. Yeah.
It's like we lose, right? So it's a very strange thing to say when I say you have to embrace losses, but that's actually it. But that's why we do risk management, because we control that element of trading or the losses. But if someone gets derailed because he just had a losing trade, then you have to look for another job, because you will lose, and you will lose on a regular basis. That just comes with the territory. And so all these elements, and that is deep psychology, right? And I work with people on that as well. And I always say to people, never fear when we start to look into your soul, because it's not about what we find. It's just when we identify things that need to be addressed. There can be trigger shyness. There can just be elements that irritate people in trading. We just have to identify them. And once we know him, we can do something about it. If we don't know him, that's exactly this uncomfortable feeling you have when you're a trader and You just don't feel right, and you don't know why. No, we just have to. There's no fear of identifying things that may not be ideal, but we need to address them and find a way around it, which most of the time there is. There's only a very few people that are just not made for it, and I tell them that as well. Right? So it's not what people want to hear, but to be honest, it doesn't often happen. It's very rare, to be honest.
Yeah, and that's that topic. I don't think we'll get into it today because I think we're about ready to close, right? But of mirror talk and how it's challenging to self-assess yourself in trading, but it's also very empowering when you have to identify things that really are not working and you just have to cut them. You know, so this is not for long-term profitability. You've no chance if you hold on to these things.
Correct, 100%. It's uncomfortable because it's not human nature to be tough with yourself, right? And that is the discipline you need to have as a trader to be actually really able to also tell yourself off and change something, right?
Yeah.
Powerful.
Beth, well, an absolute pleasure, right? A real privilege. And thank you so much for all your time. Super.
Thanks a lot. Thanks for having me, Cole. All the best.
No problem.